can just start from there. So,
Thanks.
go back to the first. That's it. Start with the first screen.
Jobseeker. So this is the fallback position by Centrelink for people who have lost their job because of the pandemic, and it's a safety net for those who won't get JobKeeper. So the Jobseeker, it's through Centrelink, and it amounts to $1,100 per fortnight, and there are some provisions that people need to meet, which are on the screen there. So Jobseeker is a little bit different from the old unemployment benefits or New Start, in that they've relaxed some of the rules around what the applicant needs to have to apply, including spouse's income, assets test, and other things. So it's making it a little bit easier for people to obtain Centrelink benefits. The JobKeeper is the next step up, which is basically administered by the Taxation Office, and businesses that qualify for JobKeeper will receive $1,500 per fortnight per employee. Now, the qualifications to get JobKeeper by an employer is that there must be a reduction in income, their turnover for the month of March, April or June compared with the same month last year. And if you don't qualify in one of those, you can do it in a future month. So the calculations for JobKeeper, the turnover can be on a cash or an accruals basis, and we've been able to obtain JobKeeper by changing their cash or accruals method that they would normally do. That's quite legal to do that. But I've found that JobKeeper has been a wonderful thing for businesses, as I was saying before, and without it, a lot of businesses would not have been able to continue and look to open up on the other side. So there are some technical things around JobKeeper. Started on the 30th of March. There must be a payment to the employee for each fortnight. That has caused some cash flow issues for some employers. They didn't have any money to pay the employees. So it meant obtaining finance, if possible, through the bank or some other avenue to have sufficient cash flow to pay the employees. One of the anomalies is that people who are working on a casual basis and were earning less than $1,500 per fortnight actually had to get paid $1,500 per fortnight. So in some circumstances, it's worked out really well for them because they actually get a pay rise. I think that is an anomaly, and good for some people, probably not so good for others. But it has been a very positive thing for the COVID situation. The cash flow for businesses is also a really important part of the stimulus package, and effectively any employers are going to receive a minimum of $20,000 in relation to the PAYG withholding on wages for their employees. So it's in three tranches, $10,000 for the March quarter, $5,000 for June, and $5,000 for September when the BAS returns are lodged. So there's a minimum of $20,000, but for larger employers, it's actually up to $100,000. So consisting of 50, 25, and 25 for those same periods. So that's been a real boost for a lot of businesses, that effectively the tax that they're withholding from employees' wages is going to be rebated or refunded by the tax office. And you know, a lot of small employers in the March BAS, for example, if their PAYG withholding was only $2,000, effectively they got an $8,000 credit against the other BAS, or a refund of that amount. So they've found that particularly good. The other method that people were able to finance the wages and paying the JobKeeper to employees was through the state government grant, which is now closed, so that Windows is shut now. But that was really helpful for a lot of our employees, that they were able to access that. The apprentice wage subsidy is also a very good one, that 50% of the apprentice's wages will be subsidised for 9 months. So that's been a really good one as well. That one needs to be applied through the organisation who have set up the apprenticeship scheme. So it's not through Centrelink, not through the tax office, but through the people who have organised the apprenticeship. The accelerated depreciation, that's changed a little bit now since I've done this slide, but basically there's a write-off of up to $150,000 per item for a business asset, and that's recently been extended. It was to finish on the 30th of June. It's now been extended by another 6 months to finish at the 31st of December this year. So one thing in relation to that is motor vehicles. We had an inquiry yesterday about a luxury vehicle from a client who wanted to write off $150,000 basically, but it is limited with motor vehicles up to the depreciation cost limit, which is about $57,000. So we're talking about business assets here. It doesn't apply to structures. For example, if you're building a shed or a factory to house plant and equipment. So there's also some provisions around loans that the government will guarantee to the lender. They'll be guarantee that the repayment will happen. I've found this not very helpful at all. The lending institutions are still wanting to make sure that the client's viable and is able to service the loan and repay it at some point in time. So I don't think we've had any clients who have taken advantage of that. And the reality of it is that the loan has to be repaid at some point anyway. The Taxation Office have been very helpful in relation to people or businesses that are in distress and are looking at insolvency, and they're cooperative in relation to extending and making payment arrangements for any outstanding tax matters or BAS that hasn't been paid. So that has been very helpful as well. Early release of super is a contentious one. In some circumstances it can work well. In some circumstances I think some early release of super will be in some ways wasted or squandered. I've seen people wanting to draw it out and then just basically have a holiday rather than use it for productive means. So the provisions around this is that there's an allowance to take $10,000 out of your superannuation up to the end of June, and also the ability to take out another $10,000 after the end of June, so 1st of July onwards. So in a couple of circumstances, we've had clients who have taken advantage of this to pay out some debt, which has worked out okay. Obviously, it affects their long-term wealth situation. So we're also taking money out of an economic environment that's quite depressed. So the share market, for example, has picked up in recent times, but earlier on it was down between 30 and 40%, and you were taking money out of an environment that effectively you were never going to get back. So it's sort of a last resort, as I see it. In some circumstances, it can work well. On the other side, if people do have some cash, it's probably an opportunity to put money into super. There's a smaller pool, and that may create some wealth creation long term. So getting through the pandemic, these are the items that I've seen as important. So cash flow is critical in all businesses at all times, but even more so at the moment. So you need to forecast your cash and regularly visit that to make sure that you've got sufficient cash to pay your expenses. Know your numbers, do your financials, speak with your accountant, see how you're travelling, renegotiate. So we've heard about renegotiating commercial and residential rent. You can also negotiate with your suppliers regarding terms. That can help your cash flow. So be open to talking with suppliers and landlords, etc. Non-essential expenses, deferring capital expenditure to a later date. There might have been something that was on the radar that needed to be done. Basically, deferring that at the present time until things are a little bit more certain. And, you know, the old term of tightening the belt is really relevant here, that we need to cut down on expenses that, if that's possible. So post-pandemic, staff and technology have to be critical of the staff levels simply from a survival point of view, and you have to look after your own business first and foremost to create that opportunity for employment further down the track. Technology, we've seen, you know, Officeworks and Harvey Norman sell out of computers and computer software and hardware and other products. People working at home, and I think generally speaking, most people have increased their technology. And for the marketers, you know, and as Chris was saying before, you know, it's really important to continue that. You know, we'll come out of the pandemic at some point, hopefully sooner rather than later, but business has to carry on. So marketing is an important aspect of that. So I can continue on, Chris, if you want me to say a little bit more regarding.
Keep going, you're doing great.
Expenses. So there's various methods of claiming expenses in your tax return. Home office expenses are a topical one at the moment. Various methods to claim that. There's what's called the shortcut method, which is 80 cents per hour, which is inclusive of all of your home heat, light and power, depreciation of computers, offices, furniture, the whole lot. The fixed rate method is a claim of 52 cents per hour for basically your home heat, light and power, but it's extended that you can also claim depreciation on computers and other equipment which is not available in the shortcut method of 80 cents. The actual cost method basically is if you have a home office that's dedicated and you're able to substantiate claiming a percentage of all of your home costs because you're operating from home. It's a little bit difficult to prove all of that, and in an audit situation, I've seen where the tax office is fairly critical on that, and need to be careful there also that if you're using your home as a business base as well, that you don't compromise your capital gains tax exemption for your principal residence. So if you're claiming, say, 10 or 20% of all of your interest on your mortgage and rates, etc., and other outgoings, potentially that same percentage capital gain won't be exempt even when you sell that property. So in some circumstances, it's better not to claim that because you get a better result by the capital gains tax exemption. So C and D there. So just some links there. The business support fund at the bottom is now closed. JobKeeper through the Taxation Office. So there's a lot in that. Some basics we've covered. There's a lot more technical items behind that. Happy to answer any questions.
Well done. That's fantastic, Bill. I've got one. I've got a contact that has accessed their super because they're thinking that they can grab that super and throw it into getting a home loan or something like that. Um, my understanding is that, like you said in your presentation, that taking the money out, unless it's for like last resort stuff, it's really not worth taking the money out at all. Is that the case?
I believe so. Yeah, I think that superannuation is a great vehicle for your long-term wealth creation and your retirement long-term, whenever that might be. If you take it out, that's going to compromise that. If you see that you can take $10,000 out and you qualify to take it out, which is basically you're on JobKeeper or you've had a 20% reduction in your income.
Yeah.
But if you see that you can put that into buying a property, for example, and maybe even take advantage of the new $25,000 home improvement grant that's been recently announced, well, there might be an opportunity there to do that and get better use out of that money. So I can understand where they're coming from. But unless you've got a situation where you can actually get a better return outside of super, I'd leave it in there. Yeah. There's been the other strategy that's been bandied around for quite a while, which is you take $10,000 out of your super, which is tax-free. Mm-hmm. You then make a $10,000 concessional contribution to your super to get a tax deduction for it going back in. The tax office are right onto that and they won't allow that.
Right. Yeah.
It was too good to be true.
Yeah.
And you had to meet certain criteria to do that anyway. But I can understand people wanting to do that, Chris, if they wanted to take it out, and that might have meant the difference between being able to get a home loan or not get a home loan, which allowed them to get into the property market, which is a little bit depressed at the moment. So it's about personal circumstances and probably running through the numbers and seeing, what is the best use of that money.
Yeah, no, I agree. It was more just an interesting conversation I was having, and I thought I'll throw it at you and just see what your response. Your response was pretty much what I was hoping you'd say, so thank you for that. So yeah, has anyone else got questions for Bill as his laptop's running out? I might take over the screen. You finished your presentation, haven't you, Bill? Yeah?
Yes.
So I'll,
I have a home office question. I've been told that unless your home office is in a separate room with a door you can close, you can't really claim it, your expenses. Is that true?
I think that's an old way of looking at it. I think things have changed a little bit, Dorothy, in relation to that. And, the old one was where you had to have a separate entrance, you had to have separate utilities, bills coming in, that sort of thing. It's more about the actual use of the room or part of your house now. So yes, I think you still can claim it.
Okay.
So with rent, for example, the tax office have said, well, you're going to be renting that property anyway. You're going to use it as your principal residence. You're going to be living there. So you've got no additional cost of renting that property to run your business from home. So you do have to be careful. You can do it. You can claim it in some circumstances, and you can claim it without having a separate entrance and separate utilities, that sort of thing. But it's probably something you need to talk to your accountant about to substantiate what you want to claim. And bear in mind that the capital gains tax exemption that I referred to before is really important. The CGT exemption on your own home is probably one of the best tax shelters around, so you don't want to compromise that at all.
Yeah, I'm renting, so that doesn't apply.
No. So,
but I do have an open plan house, so my office is in a kind of a second lounge that's all open plan.
Yeah. You need to have a chat with your accountant to go through that.
Sounds like that's you, Bill.
So there's certainly ways you can do that, and the ways you can substantiate, having that extra space that you need to claim a deduction for. So
I'll be in touch.
Okay.
Fantastic. really informative presentation there, Bill. I look forward to sharing that out to the masses because I think there'll be a lot of interesting topics in there. And I agree with Rachel, point 6 about marketing.